Hey, by the way, the dividend went up.
Yeah, saw
I
that. We'll
think
be
it's
going over
5.7.
we'll
Yeah.
be going over that. So I did want to talk about the dividends on different companies, and basically we'll talk a little bit about how they work, so you guys get a better understanding of dividends, because dividends can be confusing. The way that dividends get applied is Guardian's dividend rate for this one was 5.65%. But that wasn't necessarily what was applied to my policy. Okay. Dividends vary based on how much base premium you have, how much paid up additions you have, what health rating class that you're in, and how that's functioning within their general fund account. So what the mortality rates have been for your particular class, that can affect it as well. So the insurance company in general just declares, this is how much dividends we're paying out. This is what that looks like as a percentage, but the way it gets applied to each policy may be a little different. So we always want to consider the dividend rates as like a general number. Okay. It's a gross number for sure. It doesn't include expenses, will come out above and beyond that. Okay. But it'll get treated differently on each different account. And we know this because we get hints in places. Like we can see, if we just look at the raw numbers, we can see like, oh, that's not 5.65% of my cash value. Why isn't that? Well, there's expenses inside of it. Guardian did come out with an increase of 0.1%. So they went from 5.65 to 5.75. Not a big surprise. Remember, we've talked earlier this year about general fund accounts in insurance companies doing a lot better because the interest rate environment has gone up. Bond rates have gone up. That allows the overall general funds to do better. Now, we got the first indication of this from Allianz, and we could really see it in other IULs as well when we see fixed interest rates going up, fixed interest rate accounts going up, cap rates going up, participation rates going up. Those are clear indications that general funds are doing better from an insurance company. Okay. And general funds for insurance companies are built on long-term bonds. Okay. They buy bonds and they hold them for the entire period. They don't trade them. Our volatility indexes that our IULs get tied to, those do a lot of trading of bonds. So that's why our volatility indexes didn't do so well this year. And people say the bonds went down along with equities, right? Well, the value of bonds did go down along with equities. They both got hit hard this year, but bond rates actually went up. It's the people trading bonds that got the hit. The value of the bonds that they had already bought went down because bond rates went up. So for insurance companies, it's been a really, really good year. And we also get that indication from looking at annuities. And not many of you probably look at annuities, but annuities for the last 10 years have been bad. The rates on them have been low. The indexed annuities, the cap rates have been very low in general. Everything changed this year with annuities. They were able to bump everything up quite a bit. So annuities are a lot more attractive. I still like insurance a little bit better if you have a choice between the two. Annuities are great for qualified funds, though, if people are not ready to pull their money out of their retirement accounts, but they don't want to be exposed to the stock market. Annuities are looking really good right now. Okay. That's not a time for life insurance. They don't want to pull their money out, pay taxes, possibly a penalty because they're not retired, just to get that money into life insurance. Okay. There was a significant difference between life insurance cap rates and the growth opportunity over the last decade. That's lower now because annuities are more attractive. Okay. So just something to be aware of, but those are all indications that insurance companies' general funds are doing better. So the expectation from me was that dividend rates will slowly start to turn around. It's like a big ship. You've got these massive portfolios, these massive general fund accounts that are going to slowly start to turn up. They come down slowly and they go up slowly. Okay. So it's not like bond rates and stuff are going up immediately. They're going to start issuing higher dividends. Okay. They take their time, just like they don't want your account going up and down year after year. Okay. That looks like an unsustainable business practice. It makes people nervous to not know what anything's going to be by large numbers year to year. So insurance companies like to go down slowly and up slowly as things turn around. So we see that with Guardian. We didn't see it with the other major mutuals. So we got New York Life held steady at 5.8. If you look at the New York Life stuff, the press releases, it actually doesn't give you a percentage. It just talks about the numbers, dollar value that they put out. 5.8 last year, stayed 5.8. Okay. Mass Mutual. Mass Mutual stayed at 6%. And then Guardians, we did see the release, 5.75. And then Northwestern held steady at 5%. So Northwestern, right here, dividend rate for most products would be 5%. Okay. Now, what's interesting when we look at this stuff, and this is where you can look at the how big these companies actually are. You get an idea. Northwestern's like the biggest one out there. 18 billion in revenue. 6.5 billion is the dividend payout. Now they're a large company. They have captive agents. They sell a lot of insurance. They don't do what we do. Okay. They don't sell the products like we do. There's a really good opportunity out there. A lot of people are buying, frankly, bad cash value policies from Northwestern. Okay. And they're not getting great dividends from it either. 4.6%. If we go to Mass Mutual, dividend payout 1.9 billion. So that's like a third, less than a third of Northwestern's. Still, Mass Mutual is one of the largest mutual companies. We go to Guardians. Guardians 1.26, I believe.
Yeah, at the very top.
Was it right at the top?
Yeah, the second.
Oh, yeah, right there. 1.26 billion. So not too far behind Mass Mutual on that regard. Okay, Guardian is a smaller company than Mass Mutual. So pretty good numbers that we're seeing there. It is a record. Largest dividend. Now, insurance companies love to declare largest dividend, but like they're continuing to get new clients. So it's not necessarily a much bigger percent wise that each client is going to get. It's just a larger dollar amount, but it gets spread out over more people. So that's why Northwestern's $6 billion dividend is a lower percentage that goes out to their clients because they have a lot more clients. Okay. We've got Penn Mutual. Penn Mutual held steady, but theirs is a record dividend as well. But check this out. It's 163 million payout. Penn Mutual is a pretty good size insurance company in the scheme of things, but that's a big difference in payout between over $1 billion and 6 billion, right? So when we look at the scale of these companies, Penn Mutual is actually quite a bit smaller, but they've been around for 175 years or almost 175 years. So it is a company I do like to use. I like their product. The dividend rate is 5.75%. So Guardians jumped up to match. But the way that actually pays out, Penn Mutual, more of the dividend goes to paid up additions. So that's one of the reasons I like it. They don't have the flexibility of Guardian though. So Guardian ends up being the most popular product that we offer when it comes to people that want to generate that high cash value early on. But if you don't need flexibility in premium payments, if you don't need the ability for us to design the policy where it's like very low base, very low commitment, but the ability to dump in on an unscheduled basis like we do with Guardian, if you don't need that to qualify, Penn Mutual could be a good option. Same thing with Mass Mutual. The lack of flexibility means I recommend those two companies when we don't need that flexibility. Okay. But if you've got somebody that has $100,000 income and they want to put 50,000 into a policy each year, nobody's going to approve that. It's too big of a percentage of their income. So we use Guardian because we only need to get an approval for 5,000 in base premium, and they could dump in that 50,000 if they want to. Okay. Or you do an IUL and you could do the same thing. Okay, we have a lot of flexibility with those that you don't get from Penn Mutual, Mass Mutual. When I talked about the dividends being applied differently, here was one of the little nuggets I came across. So Sun Life, Clarica, they've got pretty good dividend numbers here, but these are like stock companies. So like one of these is Prudential, so that these guys run Mutual Life, MetLife, Clarica, Allstate, and Prudential. All those are ran under this Clarica brand, it looks like. But check this out. Reducing dividends for pro-smoker policies. This is a result of the mortality and adverse mortality review for these policies. So what they noticed is across their book of business, for people with smoking rates, they're seeing a higher mortality rate. And so they have to adjust how the dividend pays out for that particular group of business. So that's one of the reasons why you don't see the same amount applied. That 5.65 or 5.75 dividend declared rate, you're not necessarily going to see that because they may be treating your class a little bit differently. Whatever you qualified for a health rating might be treated a little bit differently based on how people are actually dying. Okay. So it's interesting. I came across that nugget, and this was what we assumed, right? We knew they applied it differently, but we don't know what goes into a lot of those decisions because they don't have to declare it. They don't have to say this stuff, right? This is probably something that comes out every once in a while from a single carrier, and it just kind of gives us a little bit of insight into what's going on inside these companies. Any questions?
So you mentioned that Penn State credits more to the cash value, the PUA.
The PUAs. Yeah, basically, we see a very similar dividend rate, but we see better long-term performance with the type of policies we design. I see a better long-term performance, even than Mass Mutual. So Penn Mutual is showing 5.75 return. Mass Mutual shows a 6. But when we show the exact same funding for the two, the Penn Mutual one outperforms it. Why is that? They're very not transparent. So we don't really know by just looking at the policies. But if we understand some of the things that happen inside these, one of the things that we know is that different carriers treat base premium and PUA differently. Guardian is one of those companies. I think Mass Mutual is one of those companies. I think Mass Mutual probably gives a little more to it, because when we used to compare Mass Mutual and Guardian, Mass Mutual would outperform Guardian, even though they're very similar in actual dividend rates. Okay. But they don't have the flexibility. So like we don't worry too much about it because it's not a huge difference in how it gets credited, but it is a difference. And it helps to understand. So if you show an illustration to somebody and they're like, why are these so different? You want to be able to let them know this is likely the reason why. They provide a little more of that dividend to the paid up additions than some of these other carriers. That's the best explanation that I can come up with without the company actually revealing their secrets to us and how they break that stuff down, because they don't do that, right? They don't. Those are all generally considered proprietary information, how they allocate their dividends, what they charge for each asset class, things like that. Those are all proprietary stuff. They won't release it unless they're forced to by the government, which is basically what IULs do. IULs, because there's some tangential tie to the stock market, they are not required, or they're not allowed to not be transparent. They have to be transparent. And so we get to see a lot of insight into how these things work. And we can apply it to whole life as well. Just like in a fixed loan, wash loan with an IUL company. You might, for the first 10 years, you're going to pay 2.9, you're going to get a credit of 2. But does it look like you get a credit of 2 if you just look at the numbers? No, because there's expenses every year that come out on top of that. So it doesn't look like you got that credit. But because the IUL has to be transparent, you can see the credit. You can see where it was credited. You can see what you paid for the interest. And then we see all the expenses that come out. And then as a percentage, obviously all the numbers work. Same thing happens inside the whole life. We just don't get to see all the underpinnings, how they do this the expenses inside of it. Okay. So there's a lot of trust you put in that whole life that it's doing what we expect it to do. Like you're getting treated fairly with how that dividend is getting allocated to your particular policy. At the base level, we have the guarantees, which is nice. We know it's always going to go up. We just don't know how it's going to go up above and beyond those guarantees based on the dividends and how those will get allocated to your particular policy. So we do want to, we do have to have some trust there, and hope we get treated fairly throughout the life of the policy. Okay. And that comes from long-term performance. Like Steve Parisi likes to talk about, was the actual performance of these policies over the long term. It doesn't matter if they're declaring a 8% dividend if you only see a 4% growth. And it's like, that's interesting. Why did that happen? Well, the declared dividend rate is just the general declared rate. That particular policy obviously didn't get credited with that full rate on all of the dollars that are inside the policy. But just something to be aware of. That does happen inside of whole life policies. So we do like to see our illustrations hold up and the projections continue to go up. I mean, the actual cash value being higher than we projected, which I expect to be the case. If we end up in a higher dividend rate environment, we should see those numbers beating it. But just keep in mind, if the numbers don't match up, it's just because it's getting allocated differently for any particular policy that you're looking at. There's not really anything we can do about it. So keeping in mind that the dividend rates are gross numbers, you're not going to see that exact number on your returns in your annual statements because the expenses are going to need to come out, and the dividends can be credited differently based on base premium, PUA, and your health rating and how the mortality expenses are affecting your particular class. Let's take a look at some top carriers' historical dividend rates. So here you can see we've got Guardian, Mass Mutual, Penn Mutual, New York Life, and Northwestern. And here we've got the average since 2002. I'll scroll down here and see these numbers since 2002. I've just ran the calculations so that we can get the average here since 2002. Guardian at 6.46, Mass Mutual 6.99, Penn Mutual 6.26, New York Life 6.29, and Northwestern 6.19. So all fairly similar. You're not going to get a big difference in cash growth. So, oftentimes when we're looking at which carrier to use, dividends are not the number one factor. We want to make sure we're using a carrier that has paid dividends out. And, Guardian, Mass Mutual, Penn Mutual all have paid above the guaranteed amount for 150 plus years. So we like to see that. New York Life, Northwestern, probably the same for them too. But we do like to see that. It is not the case with all of your whole life carriers. And these are also major mutual companies. So you become part owner of the company. There's no shareholders to have a conflict of interest when it comes to the paying out of the profits, right? So we end up with really good high dividend rates on average. So the number one factor ends up being flexibility. That's usually the first thing we look at. If you need flexibility, Guardian happens to be the most flexible. It also happens to have the second to the highest average, over the last 20 plus years. So pretty nice. Again, that's just the gross dividend rate though. It can be treated differently inside the policy. So Guardian is one of the ones that treats base premium different than PUAs when it comes to how much they credit that dividend amount. Mass Mutual does similar. Penn Mutual seems to credit a higher amount to the PUA, but Mass Mutual and Penn Mutual aren't as flexible. So you may not be able to get as much money into a policy of those two if you need flexibility in what you're required to put in compared to what you have to put in or what you can put in, right? These ones just don't have the same type of flexibility that Guardian has. So while it may end up projecting a little bit lower in the long run than these two, based on how we like to design things with a lot of PUAs, in general, you can get a lot more money into it, and the internal rate of return may be a little lower, but the actual cash value is going to be much higher because of what you were able to do as far as the funding goes. And they're actually really great when it comes to taking loans as well. Not that the other ones aren't, but you know, there's a lot of good reasons why we like these three here for our top choices. So I hope you found value in that. Thanks for joining us today. Be sure to hit that like button and subscribe if you're finding value and you want to follow along as we release more videos sharing insights on the insurance industry and how to maximize your cash flow. Thanks.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.